You were newly hired or promoted as Chief Financial Officer or CFO of a certain corporation. Consider that this corporation is a public company. Public company means its shares of stock is traded in public stock market, such as New York Stock Exchange. The market price of this stock may change every trading day based on different factors. A share of stock represents ownership in a corporation. A corporation that is publicly held is owned by hundreds or even thousands of shareholders. These shareholders come from different places and walks of life. It is very impossible for these shareholders to be directly involved in managing or controlling the business of the firm. Therefore, it is advisable to hire professionals to manage the business, such as CEO, sales director, IT head, and of course you as the CFO. This creates a separation of ownership and control. The corporation is owned by shareholders but actively managed and controlled by managers. These managers should act for the interest of the shareholders. But wait, shareholders are different from each other. They differ in terms of age and time horizon. Time horizon refers to period of time a shareholder expects to hold an investment until he needs his money back. A shareholder who is older and approaching the retirement age probably has shorter time horizon. A shareholder who wants his money back when his kids are entering college will have a medium-term horizon, while a shareholder who wants his money back after 15 years is considered to have a longer time horizon. Shareholders also differ in investment strategy, wealth, and risk tolerance. As the CFO, the big question will be, how can you satisfy all these shareholders when they are different from each other? Well, there's good news. The good news is that all these shareholders have one thing in common. They all want to be richer. In other words, they want to maximize their wealth. After all, shareholders provide funding to the firm, and therefore, there must be something in return. Shareholder wealth is represented by the market price per share of the firm's common stock. Therefore, maximizing shareholder wealth means increasing the market price of a common stock. Maximizing shareholder wealth also means increasing the value of a firm. Value of a firm is computed as current market price per share times outstanding shares. All these lead to the ultimate goal of a firm, which is the maximization of shareholder wealth. Market price of a share is affected by the decisions made by the managers. What are these decisions? These decisions are mainly grouped as investment, financing, and operating decisions. These decisions are discussed in detail on the video Financial Decisions. To see that video, click the link in the description box below. Now back to our topic. As previously mentioned, market price of a share is affected by the decisions made by the managers, and therefore, these decisions must be evaluated based on how they affect the market price of a share. If these shareholders are not satisfied with the decision and performance of the managers, they might sell their shares and invest their money in other companies. If supply of a particular stock is higher than its demand, market price of a stock will fall. This is in line with the law of supply and demand. Business strategies such as introducing a new product or expanding to new markets should only be implemented by managers if these strategies will increase the market price of the stock. Profit maximization is an important goal of a firm. After all, nobody will be happy investing in a company which is not profitable. But why profit maximization is not an ultimate goal of a firm as compared to wealth maximization? Wealth maximization considers the timing, risk, and duration of earnings, the dividend policy, and other factors that affect the stock price, while profit maximization ignores these factors. I hope you enjoy and learn a lot from this video. For more videos, click the links in the description box below or click in these end screens. Thanks for watching!